Hello and welcome to the Mutual Fund Show. My name is Neeraj Chano. The next 25 minutes we'll talk all about mutual funds. In this case, we'll talk about some of the concepts about mutual funds. Now, you already know of a number of things that you should do in mutual funds. A lot of times on this show, we try and talk about what you should not do when it comes to mutual fund investing. And in today's show, we're doing it with a bit of a twist. We're trying to challenge, or at least the guest that we have today is trying to challenge some of the known comments or adages that you hear when it comes to mutual fund investing via use of some data. Sunil Jhaveri, founder and chairman at MSJ MisterBond, joins us right now on the show. Sunil, good having you. Thanks so much for joining in. And first off, wishing you a very happy birthday.
Thank you so much, Neeraj.
All right. So now, Sunil, some of the things that we're going to talk about are pretty simple. They've worked almost all the times, or at least people believe they work all the times.
Right.
Why is it that you are saying that people shouldn't blindly believe them?
Sure. So, some of these adages or the mantras which we've been told or taught by the mutual fund industry or the finance industry, they were relevant at that point in time when they started, way back in 1995. But somehow or the other, they have started losing its significance. And I can share some data with you also. We've been saying buy and hold for a long, long time. If buy and hold was really working, then how come these statistics reveal that equity as an asset class, investors stay invested for not more than 2 to 3 years? We've been speaking about buy and hold for the last almost 25, 26 years.
Yeah, so maybe it's working, but because people are not staying put, it is not working. That's what the argument comes in, right?
Naturally. Now, you tell me whether in 2008-9 when the markets corrected by 60%, I'm asking this question to the advisors who are giving this adage or the mantra, did you or did you not panic at that time? The answer is clearly they also panicked at that point in time, and that's the reason why they also exited from equity as an asset class. How do you expect your investors to stay put during such volatile times? So that volatility is when these investors need protection. What the industry is not really understanding or realizing is that there is no strategy for downside protection. Everybody is just concentrating on upside participation. So when you have a smoother journey, then naturally the investors will stay for longer periods. But when you have really volatile journey like a ECG of a heart patient, you will definitely panic and then move out of the asset classes and maybe go back to where they came from, the traditional investments.
Okay, so let's try and talk about 3 or 4 of these. And
Sure.
the first one is arguably the most commonly used adage, which is SIPP, karo and bhul jao, fill it, shut it, forget it.
Correct.
A lot of non-mutual fund investment advice also comes in that fashion, right? That time spent in the market is more important than timing the market.
Correct.
Now, can you tell us via use of some data or some examples as to why is it that you believe that SIPP, karo or bhul jao is not necessarily the right thing?
Okay. SIP is just a strategy. What people don't realize is that they are treating it as a product. So it's just a way of investing into equity as an asset class, slowly and steadily over a period of time. But after some time, SIP is nothing but lump sum. So when I ask this question to the audiences, including the advisors or the investors who I address on a regular basis, that if I have a portfolio of 5 crores which was through a lump sum strategy, and I have a 5 crore portfolio which was developed through a SIP strategy, which one is more susceptible to volatility? See, the answer is clearly that lump sum will be more susceptible to volatility.
Really? People give that answer?
They give that answer.
Okay, interesting.
Unfortunately. But if the markets correct by 50%, both the portfolios will correct. So after some time, SIP is nothing but lump sum. Should it or should it not be protected?
It should be.
So let me give you an analogy which the viewers will understand. You play cards during Diwali. You go with say 10,000 rupees and you make say 5,000 rupees on that, and you give that 5,000 rupees to your wife and say, I will only play with that 10,000 rupees. So that is the investor's mentality. Why are we not guiding him towards that? So far nobody was guiding him towards that. And we were only saying SIPP, karo, bhul jao and continue your journey.
Okay.
So if you see the results which we have shared with you, from 2005 to 2008, when you did a SIP of 10,000 rupees per month, which is 3,60,000, went up to almost 7.5 lakhs, giving you some absurd returns of 50, 55%, etc. And then we said SIPP, karo, bhul jao. Poor investor continued his SIP journey. By 2009 March, that 5,10,000 which he had invested, or 4,80,000 which he had invested, came crashing down.
Yeah, that just so that the viewer doesn't get confused, the 4.8 lakh rupees happens because the SIP has continued from Jan 2008 to March 31st,
March
2009, and therefore
right.
a 3.4 becomes 4.8.
4.8.
Okay, yeah. Now if you can explain, yeah.
So now when they think that SIP is a product and not a strategy, over 4-year period when you deliver negative returns, would they not stick with this as an asset class or as a strategy also? So naturally they ran away. Something similar is happening in 2017 to 2019.
Can you explain?
2017, if you remember, we had done one show in May 2018 when we had spoken about why we exited, means our advisors who are following us, me and the investors, we exited in July 2017 because the markets had become extremely overvalued as per the algorithm which I have developed. And we were into a dynamic asset allocation fund. Since then to now, dynamic asset allocation funds have delivered almost 8.5 to 9%.
Mm-hmm.
Small caps are bleeding. In spite of this market having gone up to the new highs today, mid caps are still bleeding. Multi caps are maybe similar returns as your dynamic asset allocation fund, and your large caps are marginally better than, because of those polarization of 10 to 15 stocks really running away. So this journey is what we are trying to say, is that you must give smoother journey to your investors rather than a volatile journey and say SIPP karo, bhul jao, buy and hold, etc.
Okay. So yeah, the data out here suggests, right, the study of investment from 2015 to 2019, the SIP of either 10,000 or whatever it is, the amount invested would have been 5.5 lakhs in each of these schemes.
Correct.
But the value differs quite materially in that the small cap schemes have hardly given returns, but mid caps, multi caps, large caps have largely been stable. You are saying that if we contrast this to the
strategy which we were saying, that at higher valuations, what we are trying to say is that please go from an aggressive asset class to a conservative asset class, which can be a dynamic asset allocation fund.
Okay, so we'll give you, so let's then come to that. So what essentially part one of your learning is that SIPP karo and bhul jao is not necessarily the right strategy at all times. You got to balance it out or counterbalance it with some risk measures to protect the downside.
Absolutely.
Okay, one of the ways to do it would be dynamic asset allocation.
That's right. So you define what is aggressive. So aggressive schemes are your equity schemes, sectoral funds, mid cap, small cap, etc. So those are market cap biases. And your conservative would be either dynamic asset allocation fund, which moves between 30% to maximum 100% in equity, or it can be equity saving fund, or it can be liquid fund if you want to go to pure debt. But when you go to pure debt, and since July 2017 to now, markets in the red zone, and perceptibly it's still going up. So naturally your investors will start questioning that why have you taken me into debt when the equity markets are doing well. But dynamic asset allocation fund is equity as an asset class, not only from taxation point of view, but it marries fundamentals to equity investing and disinvesting, buy low, sell high, constant profit booking, not creating abhimanyus out of our equity investors. They are not stuck in a chakravyuh then.
Okay. Has history shown, I mean, this is how the dynamic asset allocation apparently helps, right? This is the chart that we put out, and some of these funds, or some of the dynamic asset allocation funds, Sunil, would have given you, if not better returns, then at least a more peaceful journey in that period. Would
Absolutely.
that be a fair assessment?
So if you see this chart itself, so from 2014 to 2019, which is the 5-year period now, the yellow line is the mid-cap line. So it's the journey of mid-cap index, which has gone up and then come down crashing. The blue line, which is the light blue line right at the bottom, is the small cap. Look at the journey. So did you or did you not know when to exit when the markets were at its peak in the small cap and the mid cap?
Okay.
The answer was clearly no.
Which is over the 5-year period.
Exactly.
In the last 2 years, and the chart that we are showing right now, this is how mutual fund returns have been over the last couple of years. Yeah.
Yeah. So this is why we've chosen the last 2 years, is because my algorithm showed exit out of equity in July 2017.
Right.
So this data is from 2017 to now.
Yes.
And again, you can see something similar where your small cap, mid cap, multi cap, all underperforming dynamic asset allocation fund. And again, Nifty 50, which is the large cap fund, large cap space, has marginally outperformed DAF. But look at the journey of the investors in each one of these categories.
When does a person shift? I mean, would you reckon that, so a dynamic asset allocation fund would be great. I mean, since 2017, there was an indicator which indicated any move out. Now, a person would ask that, let's assume that I was or I am in the dynamic asset allocation fund. what do I do? When do I swap back to a normal category? Because the same way, SIPP, karo or bhul jao is a wrong strategy.
Correct.
BAF or dynamic asset allocation or balance advantage fund, karo or bhul jao would also be a wrong strategy.
Absolutely. No, it won't be a wrong strategy because on a long-term horizon, asset allocation has outperformed buy and hold strategy also, by the way.
Okay.
But having said that, when you divide the markets into 3 zones, the red, yellow, and the green zone, depending on PE, PB, combination of PE, PB, dividend yield, momentum analysis, trend analysis, etc. You decide what you want to follow and follow that to the T. And once you have that green zone, so when the markets come into the green zone, why would you be in dynamic asset allocation fund? Why would you not go back to the equity fund?
Because you want to take the upsides, the full
Absolutely.
potential of
full
the upside.
potential of the upside. Because when the market is in the green zone, dynamic asset allocation may be 100% in equity, right? Because that's the nature of the asset class. But once the market starts going up, it will start reducing from 100 to 90 to 80 to 70. But between the red and the green zone, there is that yellow zone. I want to capture that. So that capture can happen when you actually switch to pure equity funds again.
Now, for a lot of viewers who must be thinking, what is the red, yellow, and the green zone? It's something that Sunil devised. You can have your own sets of parameters wherein instead of a red, yellow, and a green zone, you could have a peak, a center, and a trough. And essentially, when the markets look cheap, when they're at the trough zone, is when you probably load up on equity funds, pure play equity funds, and the markets look expensive based on various parameters that Sunil said. You move out of pure play equity funds into maybe the balance advantage funds or the dynamic asset allocation funds. So you can, the nomenclature can be whatever.
Correct, absolutely. It can be dynamic equity, balance advantage, dynamic asset allocation fund.
Or red, green, yellow, or cheap, or expensive, moderate, and cheap, whichever way you want to put it.
Have some discipline.
Have some discipline, I know.
Which is not there.
Which is not there, yeah. Okay, one form of discipline would be and the views are divided out here, Sunil. I'm just moving ahead. Sure. The views are divided out here. There are enough and more advisors, your peer set, who have come and said that you should take advantage of the credit risk funds because the YTMs are very, very healthy. The yield to maturities, essentially, viewers, are very healthy.
Absolutely.
And there are 1 or 2 advisors who've come and said that they are not comfortable with this strategy simply because they believe that if I want to take risk, I might as well take risk in equity funds. Sure. I don't want to take risk via debt funds. Now, sure. What's your view out here on debt funds by and large and on the credit risk funds?
Sure. First and foremost, you must understand, the viewers must understand what is the asset allocation strategy. When you're in asset allocation strategy and you're following it to the T, when the one asset class is risky, which is the equity I'm talking about and referring to right now, that means the valuations are high, why would you take unnecessary risk in the other asset class? Because that is the asset class which is supposed to be temporary parking of funds so that finally you switch from that debt to equity when the market becomes cheaper. Because when we have moved out of equity as an asset class at the expensive valuation zones, you are expecting that the markets will correct. And when the markets are correcting, why would you take extra risk in the credit risk space?
Okay, so you are saying that...
But I'm not against credit risk space. So let me qualify my statement again. So this is for viewers to understand why credit risk space should not be as part of your asset allocation strategy. Because you're taking risk on both sides, both in the equity side and on the debt side also. But if you understand credit risk, it's a very clear nomenclature. It's a credit risk. So there will be defaults, there will be downgrades, there will be delays in their interest rate payments or principal, etc. Take it in your stride. Because once you take it in your stride, because this particular percentage of that holding, it will be minuscule in that overall portfolio of that scheme. That's one side of the story. But you have only a small percentage of your clients' investments into that scheme. So on the overall portfolio of yours, that blip is so minuscule, then people are just unnecessarily panicking.
Okay.
So if you write that and the accrual of the rest of the space, because there is a 10, 11, 12% kind of an accrual. Let's assume there are 2 or 3 defaults. With 2 or 3 percentage of points shaved off from your returns, you're still in the hugely positive territory. Okay. Versus a AAA which will give you only 6.5%, 7%.
Yeah, but you've got to be prepared for that. I think you've got to go into this with your eyes open.
Exactly. And then you stop listening around that negative noise around it.
Negative noise around it. That's true. Okay. Viewers, by the way, I know there are a few queries that we already received on Twitter, but there are some queries that have come in on YouTube as well from Piyush and DN Bhattacharya, and we'll try and take some of these or all of these queries as the show progresses. But we have one important thing to discuss before we move on to the queries, and that is the last piece that I want to discuss with Sunil Jhaveri before we get into the queries, and that is on the importance of rolling returns. Now, we've spoken about this in the past as a separate show as well, but Sunil, a lot of people would want to know that what is this concept of rolling returns, and why is it that it's a better way, if it is, to measure my mutual fund returns as opposed to the normal point-to-point returns that almost everybody gives me?
Sure. See, point-to-point returns is a post-mortem of what has already happened, correct? So it can be last 6 months, last 1 year. So 1 year back, if you had invested in your scheme, let's assume an equity scheme, and the markets had really were at the rock bottom, and you had invested. So let me give you 2 examples. January 2008, if you had invested in equity and you do a point-to-point returns of Nifty 50 till now, which is 11 years, it's 5.5% only. But 1 year down the line, if you would have invested in March 2009 when the markets were at its rock bottom, and from then to now the Nifty 50 return is almost 15%. So how do you gauge that, this is good or this is bad? So point-to-point is a post-mortem of past performance. That's one of the criteria. What does rolling return tell you? If I had invested from 2001 to 2019, any time, 2001, 2002, 2003, 4, XYZ, and after that I held it for 3 years or a 5-year period, any of these observations, what is my return? So the rolling returns analysis throws up 3 things: the minimum return, the maximum return, and the average return, and finally the standard deviation also. So when you have the minimum, maximum, and average, nothing can be hidden. All the observations are covered. And if you show the audiences the chart which I had shared with you. So
yeah, we have the data for sure. So we have the data, Sunil, which speaks about this simple annualized returns.
Correct.
And right there on your screen, the minimum, maximum, and the average, with the standard deviations and the negative observations and the total observations. So 233 total observations. Now, can you explain this? Okay.
So the top portion is the point-to-point returns, which was as on 1st of June 2013, if I'm not mistaken.
Yes.
And backwards, 6 months, 1 year, 3 months, etc. And all the returns are in the 12 to 16% category. And this is, mind you, a debt scheme with 1 month exit load. So whenever somebody is coming into this scheme, that means his time horizon is not more than a month. He can stay for more than a month.
But usually it isn't.
Typically, because it's a 1 month exit load debt product, I will come here with a 1 month horizon, investment horizon. After looking at this particular data, if I would have invested in this scheme from 2013 May to 2014 May, any time during this period, that 1 month, daily 1 month rolling return shows that the minimum return was negative and the average return was 4.5%. And 63 out of 233 observations were negative. Now, looking at the rolling returns data, would you have invested in this scheme?
Okay, that's the question that pops up.
Yeah.
And that's the data, that's the power of the data.
That's the power of the data, because here nothing, good, bad, ugly, everything is there.
Okay.
And then you, with your eyes open, you say, yes, I don't mind investing, or I do mind investing. That's the call which you will take with your financial advisor.
Okay, so would you as a financial advisor give your clients the access of rolling returns on the investments they've done?
Only. So I've been telling the advisors who I mentor that somebody shows you point-to-point returns, throw it in the dustbin. Okay. Insist on a rolling returns analysis and then take a call, because that gives you consistency of returns analysis, which you're rolling point-to-point returns. Now, let me ask you this question. If the underlying securities are earning you 7 or 8%, which is on the debt side, can you sustainably get 11, 12, 15, 16% returns? Answer
Obviously
is clearly no. So that means 99% of the time, based on this past performance, the story is behind you and not in front of you. Okay. Especially in an asset class like debt.
Most importantly, okay. And therefore, maybe insisting on rolling returns or trying to understand what the rolling returns would be very, very important.
Absolutely.
Okay, great. Yeah. So, well, 3 or 4 things. One, don't look at the point-to-point returns. While people might give them to you, the better thing to do would be rolling returns. If you are indeed looking at risk aversion, or if you find that equities are risky, do not get into credit risk funds, which are also risky in nature. So Sunil's trying to tell that the whole theory of going into credit risk funds because you think equities are risky and therefore parking yourself there is bunkum. And Of course, SIPP, karo and bhul jao need not necessarily work out all the time. In fact, it has not worked out all the time as per Sunil's data. So try and be a bit more nimble.
Absolutely.
Okay.
Yes.
We've got a bunch of queries, Sunil, so we'll try and answer some of these.
Yeah,
I'll take them as they are coming. Maybe you study some of these funds, maybe you don't. So please feel free to tell a no when you don't have the answers. The first query that has come in a couple of days back is from Ashish Jain. He asks for your suggestion on the Franklin Templeton short-term income plan, which has a 4% exposure to Vodafone Idea. Should one hold or exit?
Okay. This is a typical question, as I just explained to you, that which keeps coming up. It's a credit risk fund. There will be these defaults, delays, downgrades. And by the way, it's just a downgrade. So they have marked it down by 30% so far. In spite of that markdown, they are in the top quartile performer, Franklin Templeton the short-term income plan. My suggestion would be, and the YTMs, the yields have gone up to almost as high as 11 to 12%, thanks to this markdown. Now, at the current juncture, it's like saying that when the market's corrected from 21,000 to 9,000, should I exit at 9,000? Answer is clearly no. I'm giving an analogy of equity as an asset class. So something similar has happened here. If the yields have gone up, that means your NAVs have corrected. This is the time to either hold or add on.
Okay.
This is an opportunity for somebody to invest.
And is this
with a 3 to 5 year view?
And is this opportunity for somebody who is completely risk averse as well, or this is for somebody who is okay with taking a little bit of risk?
No, when you say risk averse, that means this. See, credit risk fund will have volatility attached to it. Very plain and simple. So you must answer your own self whether I don't mind this volatility, but I don't mind that extra return. Now, when you have a 12% kind of a YTM, and let's assume there are some defaults also, it will shave off a couple of percentage points from your returns. You're still better off than a AAA, which will be giving you 6%.
Yeah, sure. This will be, even if it shaves off 2 percentage points, you'll probably still be at 10%, which is quite spectacular.
So people don't see it from that point of view. They're only listening to the negative noise which is floating around.
Mind you, in case you're confused that why is it that in point number 3, Sunil is saying that don't opt for credit risk funds if you find equities risky. Sunil is saying that if for somebody who's okay with a little bit of volatility, these funds might be a good option. Okay, great. One more query that came in from Yash Sancheti, and I don't know if you can probably answer this in the equities format, but maybe try and answer it in the mutual fund format. He asked that many fund managers are saying that high returns will be in mid caps and small caps maybe, and that's true. Almost everybody tells this to me as well. He's asking for suggestions in which segment in mid caps will do well in the long term. Now, you may not have an answer about sectors, Sunil, but do you have a sense of whether there are some good quality mid-cap funds which could be invested in sectors which could do well and therefore they could be worth investing in?
See, first and foremost, my answer to any query like this is that please be in the multi-cap fund. So that market cap bias, you leave it to the fund manager. So if the fund manager thinks there is value in small cap or there is value in mid-cap, let them decide that how much I can go higher or lower in that particular segment through my multi-cap fund, rather than getting into a mid cap and a small cap and not knowing when to exit again. So as you've just shown that slide of the chart, the mid caps and the small caps were peaking way beyond the large caps, and then all of a sudden that correction happened. Now going forward, this is my belief, I may or may not be correct, if there is a bubble in the quality large cap stocks currently, which is again floating around, and if that starts correcting, you think the mid caps and small caps also will be spared?
Yeah, well, debatable. There are, even in these times when some of the...
I'm not saying that they may do well, but...
but you are right. The large sentiment, they are sentiment boosters or sentiment dampeners.
Small cap is definitely a sentiment-driven segment.
Sure.
Because, some of the small caps, they don't have earnings. So, that's why the P's are high.
Okay, a couple of very quick questions, and again these are we haven't framed them, but I'm just taking them off the fly because they've been put out. Okay, there is one more, that we have from Siddhak Singh Saluja. With the Indian economy slowing down and earnings growth not visible, is it a good idea to invest in the likes of PPFAS or Motilal Oswal fund of funds to benefit from the geographical diversification?
So geographical diversification is talking about is the global market diversification. I'm assuming because they have some portion of it going into the global market.
Yeah, PPFAS does, right? Yeah, and Motilal Oswal Fund of Funds probably invests into the US funds directly. So is it a good idea to do that?
It's a good idea on an ongoing basis, but at the current juncture, I really can't answer that. Because the global markets are also overheated, especially the US markets.
Okay, so you talk. I mean, well, again,
it's a good idea.
It's I think that's the distinction that I want to make. That in general, Sunil believes it's a good idea.
Yes.
But Sunil is equipped enough to time that. If you're equipped in order to time that, then don't go out and do it right now. But otherwise, in general, it seems to be a good idea.
Yes, absolutely. It's a dollar diversification also, and it's a geographical diversification also. So both ways, it's a good idea. So there is a home bias. When you invest in the domestic markets, there's always that home bias because I understand the markets. Why I don't want to go to US because I don't understand that market.
Should people, just very quickly, and you've got one more question, but should people do this only after they have reached a particular scale of investments in mutual funds, the geographical diversification? I mean, at least start investing and reach a particular critical mass before you think of diversification?
Not really.
Not really. You can even if you're starting off.
When you do a SIP, then average, rupee cost average.
No, for a student who's 18 and starting off his investments in mutual funds.
Even better.
Oh, even better, you're saying. So geographical diversification.
Younger the better because then you have a much longer horizon for you to take.
In terms of the geographical diversification
absolutely.
funds as well. Okay, great. On YouTube, there's a query that has come in. I don't know if you can answer this or no, but Piyush is asking whether Birla Sun Life Frontline Equity is worth to continue in.
Very difficult because you can't answer piecemeal in terms of when did he invest, what did he invest, how much did he invest. So it's very difficult to answer a specific query whether he's holding, not holding, etc.
Okay. Ashish Darji is asking whether government employees, can they invest directly into the stock markets or do they have to compulsorily invest through mutual funds only? I doubt there is a regulation like this.
There's no regulation like that.
Yeah. So Ashish, I think the simple answer to your question is if you want to invest in stock markets directly, please open a demat account and start investing.
By the way, I don't have a demat account. I only invest through mutual funds.
Because you are investing only through mutual funds. Yeah, that's a fair call. Okay. And one last question that has come in is from Mausam Das. He's asking about his investments in SIPs into Reliance Large Cap, Reliance Consumption, ICICI Banking Financial, ABSL Frontline Equity, and HDFC Index Fund. All of them are on for the last 2 years, if I'm not wrong. Should he continue or should he change?
Absolutely, continue. Because, the longer you stay, finally it's the rupee cost averaging. So in 2 years' time, if you actually exit, you may get out at a loss also. And I've told you this earlier also in, I think, an earlier show that he should pray that whenever the SIPs are happening, the market should correct.
Correct.
You should be collecting more units than less units.
Okay, yeah, that's a behavioral thing. But again, viewers, I know there are a few more queries, but we are out of time on this leg of the mutual fund show. But Sunil, take a moment to thank you for joining in today, clearing some of our myths around the age-old mantras. Really,
all I was trying to do was unlearn to relearn, because some of these adages have become counterproductive, they become redundant. If you continue to speak the same language, we are becoming complacent.
Yeah.
In spite of the fact that the writing is on the wall, we are seeing the statistics where SIPP, karo, bhul jao, buy and hold is really not working. Then why would you continue doing that?
Well, that's a birthday gift that you've given us. But on all of us, wishing you a happy birthday once again, Sunil.
Thank you
so much for
much.
joining in today. And viewers, thanks for tuning into this leg of the Mutual Fund Show.